Welcome to Let's Chat, the show where we talk about how to prepare your business for sale. If you've got an automotive repair shop and you're thinking about selling your business down the road, this is a great series so that you can help prepare yourself not only to increase your chances of actually selling your business, but so you can maximize your sales price when you do go to sell and you get the best terms possible. I'm really excited today because today that we have with us Diana Miller-Lloyd. She is a certified public accountant, a certified fraud examiner, and a certified valuation analyst. And we've had several conversations, and I'm really impressed with her. And the reason why I wanted to invite her on the show today is because she might be somebody that a buyer of your automotive repair shop might engage with to do the due diligence on your business. So if you're looking to sell your business in a couple years from now, this episode, we will be talking with her so you can kind of get an idea of the things that she'll be looking at for a buyer. And if you're a buyer looking to acquire an automotive repair shop, Diana might be somebody that'd be great to help you assist with that process to make sure that you're buying the right thing. How you doing today, Diana?
I'm doing fantastic. How about you?
I'm doing wonderful. I'm so excited to have you on. Thank you for taking the time out to spend some time with us today.
Thank you for having me.
Hey, can we just start? Maybe just you can share a little bit about your background and what forensic accounting entails.
Sure. I am a forensic accountant and a business evaluator. Forensic accountants are engaged in due diligence for businesses, mergers and acquisitions, in government agencies, law firms, and many other aspects in courts where we are digging deep. We dig so deep that we're able to reveal what is true and what is not true. That can make the sale happen smoother and more efficient, or it gives an option for a seller or buyer to walk away from the idea of buying or selling a business.
That's fantastic, Diana. And before we go any further, I do want to point out to our audience, because they might be unaware of this, this isn't my average, but the national average is that 50% of the deals that go under contract when somebody's trying to acquire a business fall apart before they get to the closing table. So, don't just brush this off and like, hey, this is no big deal. When a buyer puts an offer in on your business and you accept that offer and we're under contract, the buyer's going to have the opportunity to do their due diligence to make sure that all the information that they've been told up to that point is true and accurate, and they can walk away at the end of the day if there's some irregular situation happening in the business. So 50%, that's an estimated national average of deals that fall apart. So if you're listening to this, I want to make sure that you really hear what Diana's saying so that when you are ready to sell, you're going to fly through the due diligence process. So what role does forensic accounting play in the process of buying or selling a business?
So the forensic accountant plays a very crucial role in process of buying and selling auto repair businesses by ensuring transparency, verifying financial claims, identifying potential risks or irregularities. And what we do is we bring to light everything that is hidden. The assets, liabilities, the operational problems, the marketing structure, everything that is under the sun that is hidden comes to light.
Okay, good. And what does the typical due diligence process look like involving an auto repair shop? Like if you're working with a buyer, what kind of things would you be asking for, and what does the process look like?
Due diligence is a critical step in the process because it ensures that all aspects of the business are thoroughly analyzed and evaluated before finalizing the transaction. The process is essential for mitigating risks, identifying potential issues, and ensuring that the buyer and the seller are making informed decisions. And the way it looks like, it starts with financial statements. That give a snapshot of what the business looks like. Is it profitable? What are the gross margins? Is it going to be a longevity business for the buyer? Are there any red flags? How is the owner involved? So your typical due diligence is very your typical due diligence varies based on the size of the business as well as the location and which state it's located at, because the rules of compliance differ from state to state.
Okay. And what kind of things do you look at as far as information? What kind of information do you request the seller? And I'm not expecting you to list everything. I just want the listeners to kind of get an idea of what kind of information that you request from a seller when you're doing the due diligence for a buyer.
I request from the seller the financial statements for the past 5 years. Typically, it's 3 to 5 years, but it's beautiful to have them for 5 years. Tax returns, completed to business tax returns that for a business, to compare them with each other. The bank statements as well for past 2-3 years, to be able to verify the legitimacy of the financial statements. Legal information, insurance information, and the list goes on and on.
Yeah.
So these are
merchant
just
statements, right?
yes, absolutely. And sometimes I even ask for personal financial tax returns and financial statements to see how the owner is intertwined in his business.
Yeah, and in a situation like that, just so that if you're listening as a seller or a buyer, in a situation like that, usually what we'll do is we'll set it up in a situation that if somebody like Diana is asking for personal tax returns, we won't provide those to the buyer themselves because it's not important for the buyer to know that to see those personal tax returns. They only need to concentrate on the business, but we can set it up where we give Diana or somebody like her the personal tax returns of the owner if they're requesting it, so they can see how it's tying in with the business, probably with K1s and things like that, right, Diana?
Exactly.
Okay.
Exactly.
All right, cool. So what are some of the biggest red flags that you see when you're doing the due diligence? What are the things that are the most common?
So the most common things that I see are inconsistent financial statements declaring revenues, that are different from the tax returns, cash payments, inventories that are not adjusted, sometimes fluctuating inventories that are not based on books, or low on books or too high. It really depends. These are red flags that, I often come across,
Mm-hmm. And you're
just
just
to
you're
name
just
a few.
and you're cross-referencing the bank statements to the financials and the tax returns, making sure it's all accurate. The merchant statements, anything that has to do with financials. And I think this is a good time to point out too. And I don't know what you experienced on your end, Diane. I would love to hear your thought process. But I think business owners, the reason why somebody gets into business is because obviously there's a dream of theirs, but the type of person that gets into this, that becomes an owner of a business, is usually very confident in themselves. They're very good at the vision and creating the vision and the high level stuff, but they tend not to be, and I don't mean to be critical, it's just what I see stereotypical of a business owner is they're very good at the vision. They're not the best at the detail type stuff. And so when you're getting ready to sell your business and you're a couple years out, like, you need to make sure that you're keeping all your financial information, your bank statements, your merchant service statements, your financials, keep it in, and also make sure that it's organized. So anything, your insurance paperwork, anything that you've got paperwork wise, take the time to start getting that stuff organized so that when you do go under contract with a buyer and you're going through the due diligence process, and the buyer or their CPA or whoever's doing their due diligence, somebody like Diana, when they ask for that information, not only do you have it, but it's easy for you to track down and get that information over, because I know sometimes sellers are like, oh, I have that somewhere, and it takes them a long time to locate it
That's
and find
right.
it, things like
It's
that. So,
important for them to have the good books and records, including their payroll records, their employee human resources in check, as well as all of their receipts, inventory, accounts payable, accounts receivables, cash statements of cash flows, and be in compliance with taxation.
Yeah.
Especially if they have taxes in their state to pay and property taxes and whatnot. And that's important because it can make it or break the deal if they
And
don't
make
have
sure the
that
corporation's up
information.
to date and, with the state
Hmm.
and everything
With
like
the
that as
state,
well. You've
yeah.
got to be compliant with, everything that has to do with legal issues with the government, legal issues in general. And
Lawsuits, yeah. Mm.
lawsuits, yeah, I can't. I talked to somebody, yeah, Diana, I talked to somebody a couple weeks ago that wants to sell their auto repair shop, and they're actually involved in a lawsuit right now. And unfortunately, I had to tell them you have to wait till you get that completely resolved before you go to the market, because obviously, legal issues like that, buyers are just not going to get involved in a situation like that. It's got to be completely
Exactly.
resolved, and really, you should disclose that at the appropriate time with the buyer as well, what had
Yes.
happened. I'm not saying you talk to every single buyer about it, but once you start getting into conversations with the more serious buyers, the buyers that are ready to put in offers on, and you need to disclose that kind of stuff and explain the story, and not let, because I'm sure this is probably the worst thing you hate seeing, Diana, because this is the worst thing I see buyers and people that do due diligence like you, is that they find out things that are negative about the business during the due diligence process, and you lose that trust, with the
That's
buyer.
right. And that's why transparency is the key element in gaining that trust and maintaining that trust throughout the due diligence process.
Exactly. Because I look at, like, when you're going to buy a house or a piece of commercial property, you could care less who the owner was, or is. When you're buying a business, the buyer must like. This is what I've seen in my nearly 25 years of doing this. You've got to like and trust that seller, and that is so crucial. And if a buyer goes into due diligence and they start discovering things that you weren't transparent about, like Diana said, you lose that trust immediately, and the buyer's going to walk away, because they're going to be like, what other things might come up that we're unaware of that we may not find out in the due diligence process? Because due diligence is pretty thorough, very, very thorough,
Very
especially when they're
thorough.
hiring somebody like you that's, forensic accountant. They're very, very thorough, but then there's other times you can't find out everything. You know what I mean? There might be something that's not on any kind of documents or anything like that. So they start to question it.
And then when that happens is then they go into lawsuit post sale
Mm-hmm.
that adjust the price or adjust the terms of the purchase,
Exactly.
because those things were not revealed ahead of the time.
Most of the business owners that I'm talking to now, Diana, are looking to retire. In the last 3 to 5 years, I mainly work with people that are looking to retire. Before that, the rest of my career, I might get one or two people a year that were looking to sell their business to retire, but the rest were selling it for other reasons, like burnout or going through a divorce or a health issue or something like that. But with like 40% of all business owners being born before 1964, we have a large population of business people that own auto repair shops that are looking to retire, and that's why they're selling. And the last thing you want to do when you sell your business, and let's say you're going to get in your RV and travel the country with your spouse, is looking over your shoulder on a potential lawsuit like you're talking about, Diana. That's why it's just
Right.
put everything out there. And if the buyer walks away, the buyer walks away. You find another buyer. It's better to have that situation than be looking at something post-closing when you're trying to enjoy the best time of your life in retirement with your spouse and your grandkids and your kids and things like that. So,
Especially when it comes down to lending. A lot of times people have a lender like SBA or
mm-hmm.
a conventional loan where they have to put down some percentage. And then if that's SBA or a bank that is looking at their underwriting, they will have a situation where they might pull the loan and shut you down because of those uh, lawsuits or anything. Like, we didn't know, what do we do now? If we knew about it, we would have never approved that loan.
Mm-hmm.
So that is being upfront, or have a plan to remediate the situation might be a way to go.
Yeah. And you're talking about the SBA loans. You're talking about, a business that typically sells between 500,000 and $3 or $4 million is very, 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 very high chance, like 95% chance that the buyer is going to be getting an SBA loan. So you have to worry about that situation. And then when you start to sell businesses for 5 million, 10 million, 15 million, 30 million, you're starting to get into private equity groups, things like that. And, industry players that are buying businesses all the time. They have their own team, and you're dealing with private equity groups, and they tend to they're very thorough on their due diligence. They actually do what's called quality of earnings reports. And
That's right.
maybe you just touch real quick on the difference between a regular due diligence and a Q of E is what the quality of earnings is nicknamed.
So the due diligence is the revealing and being transparent with everything that is going on. It does not translate into the quality of earnings report. However, the venture capital firms or family offices, they prepare that report that actually looks at longevity, how long the business would be have life in it.
Mm-hmm.
So, and that matrix shows that type of matrix talks about the quality of the business. And if they pass the level of that scorecard, then they will be in it, or they may want to withdraw from the offer.
Or renegotiate the offer itself.
Or negotiate the offer, yeah.
Yeah. So the due diligence, so regular due diligence for a smaller business is very thorough. Quality of earnings reports, on businesses that are going to sell for 20 million, 30 million, 40 million. It's due diligence on steroids, basically.
That's right.
It's extremely, extremely thorough. So what are the biggest mistakes that you see business owners make when to make the due diligence process more complicated?
Well, they would have two sets of books, one for cash, another one for reporting. That is one of the red flags that I see. That's often happens in the small businesses that are under $5 million. Mm-hmm. And when somebody comes in and says, I got a bag of cash and sell me this car, they believe that they don't have to report it.
Mm-hmm.
You see. And then they keep it somewhere else, and they don't pay, it doesn't trickle into the business at all. So as a result of it, the numbers are skewed, and the gross revenue as well as the net revenue.
Yep,
so
gross profit.
One of the things is that I ask is to recognize the problem, that you have cash coming in, and that cash needs to be recorded and reflected on financial statements, so that when the seller presents its numbers, they're not different from what they say.
Yeah, let's touch on this a little bit more in detail, Diana. I'm so glad you brought that up, because that's probably the biggest thing that I see, business owners of auto repair shops make is that, and you mentioned the cash. I'm going to go one step further, and it's not just the cash. It's also business owners tend to run a lot of personal expenses through the business.
Yes, they do.
You if you're thinking about selling, you should be doing it anyways. I mean, even if you're not thinking about selling your business, you should do it anyways, because it's going to give you a better idea from a financial perspective of how well you're doing, and you're able to manage things better. Plus, you're not looking over your shoulders, all the time to the IRS or anything like that. But if you're selling your business, a couple years before you ready to sell your business, you need to make sure you do it, because, it's not buyers nowadays. I know. So I talk to business owners who are like, oh, I can prove that X amount was a personal expense, not a business expense, and I can prove all this and blah, blah, blah. Well, sometimes you can't, and other times when it can be done, buyers don't like to see that kind of stuff anymore. And then when you try to get a loan, the buyer tries to get a loan on the business to acquire the business, the lenders are not going to accept that. Like, I think that's the most critical thing. If somebody's listening to this right now and they're thinking about selling their business in a couple of years, and again, even if you're not thinking about selling your business, start taking out all the personal expenses and just keeping business expenses in your business, because you're not gonna ever get, you're never gonna get the full amount for your business otherwise. Like,
That's right. Because
Diana,
of the evaluation. Because of the evaluation that comes down significantly. However, business owners do not know often what the business expense and personal expenses are. They have an idea, but they don't know what qualifies something as a business or personal expense. I come across that very often. What they think is a personal expense is a business expense, and vice versa. So it's important to work with a good qualified specialist so that they could educate them on consistent basis, like a CPA, an accountant who could continuously work with them in preparing the books correctly for the IRS purposes, and then for business valuation and due diligence purposes if they are preparing for a sale, or just overall for compliance purposes. It's a good practice to have.
absolutely, absolutely. And let's go back to what we were talking about earlier. You were talking about the different documents you need and why you need them when you're doing the due diligence. You're handing over your bank statements. The reason that somebody like Diana and a buyer wants to see the bank statements is because they want to go line item by line item and see how that reflects back to the P&Ls and the tax returns and things like that. And if you've got all these personal expenses in your bank statements, it makes it very difficult to pull those out. And then it's guessing what is personal, what's business, not sure what it is. And there's no way to really tell. Even if you say as a seller, well, that's, you can tell that that's a personal expense. It's
That's
a
right.
huge black eye on the situation. And, you're looking at the situation, national averages. I sell 90% of the businesses I take to the market, but the national average is that only 10 to 20% of businesses for sale are actually going to sell, Diana. And so, and one of the number one reasons that they don't sell is because of the financial situation of the business. And that's what I see as a broker as being the biggest problem when I'm talking to a seller for the first time, is that they're using their personal debt or their business debit card as a personal debit card or credit card, however you want to use it. But
That's right.
And
They're
you
living
hate
out
that
of their
as
businesses. They're living out of their businesses instead of paying themselves a salary,
yep.
which would become fully deductible if they just gave themselves a salary or an owner's draw.
Yeah. And then you know what? Banks aren't going to like it either. The banks aren't going to lend with that kind of money either. And then a bank's not going to go through a general ledger line item by line item. They're just not going to do that. They don't accept personal expenses, so you're losing out. So what you're talking, it's exactly what you're talking about is, and I use this example all the time, is that for every dollar that you're trying to write off as a personal expense, or every dollar that you're receiving in cash that you're not reporting, even if you're in the highest tax bracket, you're saving 37 cents on that dollar in taxes. But when you go to sell your business, you're losing out on $2, $3, $4, $5 or more on that same dollar. So you're saving pennies on taxes, and you're losing out on dollars when you go to sell your business.
That's right. And there are very good financial or even taxation-wise strategies where you can save legally on taxes. You don't have to write off everything. There are many strategies, and working with a specialist actually who specializes in retirement and benefits and everything else is the key role to be able to save on taxes, and then your financials will look healthier. So the tax code allows for legal exemptions and deductions. It's just a matter of following that and not converting everything into personal expense or business expense. From personal.
And you're getting close to retirement, you can do things like SEPs, or you can do things like cash balance plans, or different kinds of things. I mean, we're not going to get into that now, but there are things you can get with your financial advisor about. Can you give some examples of like financial inconsistencies that potentially you seem to derail a sale?
Sure. Financial inconsistencies like, having transparency in financial statements, that the tax records say one thing and then your books say, your financial statements and balance sheet and statement of cash flow say give completely different picture. Very aggressive projections, for example, could be very also that are inconsistent with the financial historical data. Inconsistencies, inventories, and liabilities could be also a red flag and an issue with the business. Having too many loans or hiding the loans from declaring them on the balance sheet could be also inconsistent, and then you need to find during due diligence it's revealed. So having all of those things, some of these things, in check would ensure that the sale would go through better unless they're hidden.
Yep, yep. You know what I see, the smaller shops, sometimes they take all their financial information at the beginning of the year from the previous year to their CPA, and they say, hey, need to do my tax returns, and they're not doing monthly P&Ls, and they're not engaging with a bookkeeper or their accountant to do monthly P&Ls or monthly financials in general. And that makes it really hard when you go to sell too, because now all you've really got at the end of the day is your business tax returns. And buyers, no matter the size of the business, buyers want to see, like you said, profit and loss statements, balance sheets on a monthly basis, quarterly basis, year over year. And, so if you are thinking about selling your business, you should engage a bookkeeper. It might cost you a couple $100 a month, and start getting your financials done on a monthly basis. Because it makes it hard for you, because it's really hard to do the due diligence otherwise.
Well, my process is a little bit different than the regular forensic accountant, because I was taught to reconstruct books and records from the beginning. So instead of, I obtain their bank statements and I reconstruct them, and then I sit down with the owner of the bank statements and I go over items that I can't recognize. But I have very good idea about what they are, and that if I can't recognize them, they're probably personal items. So at the end of the conclusion of the reconstructing those books and records and comparing them to the tax returns, the financials are like night and day.
Mm-hmm.
So it gives a different picture than what their taxes. Taxes are for reasons of lowering the taxable income.
Mm-hmm.
Whereas the diligence process and forensic accounting prepares a picture of these are your true numbers. So
Right.
they reveal different picture.
Right. Well, what about the situation? We talked about the situation where the person is only bringing their stuff once a year to their CPA, giving them all the information. They're just doing the tax return, and they're not doing monthly P&Ls. We've got the other situation that goes on too, is the where the spouse is doing the bookkeeping, and they're doing the bookkeeping, and they're not usually trained properly in doing the bookkeeping. And I sold a business last year, Diana. It ended up selling for $25 million. And the wife for years had been doing the books herself. And when we went under contract, the whole way through, I was like, hey, you sure everything's right? Blah, 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 blah. And, they actually is such a big business, $25 million sale, that the buyer was an industry buyer backed by a private equity group from a financial perspective. They did a quality of earnings report on the business, and it flew through the quality of earnings report. The financials were, the wife had done a fantastic job, absolutely wonderful job with it. But that's typically not what I see. Typically when a spouse is doing it, things are categorized wrong, and it's kind of a mess. What's your experience been with a spouse that's done the bookkeeping.
Usually when spouses keep the track of the finances like that and doing bookkeeping, if they don't have the right training, in your case, she was a pro,
Yeah.
and she did everything right. But majority of it, that's an exception.
Yeah, it
But the
is.
majority of the things that I see and it happens more in smaller businesses than larger businesses, they are, in smaller businesses, they do run things, that are incorrect. And they're putting their personal matters in, and they're looking at their spouses doing the bookkeeping, and then the spouse is not very trained in that, or they got a bad advice, because they want to save a couple of dollars on the bookkeeping
Yep.
function.
The categorizing things wrong, and they're not, yeah,
Yeah, putting things in the wrong categories, not reconciling on monthly basis, not sitting together with a fractional CFO. If they don't have a bookkeeper, they should get a fractional CFO who would come and correct things. You don't have to hire someone on full-time basis, but you can get somebody as a professional on a fractional, coming in once a month and going over the books and saying, okay, where are you at? And how can I take you to the growth of the next level? That's the beauty of fractional CFO. But if the spouse is doing all of those functions and she's not properly trained and doesn't have a finance background or even accounting background, those businesses tend to slide slowly but surely at the lower price points than anything else.
Yeah, yeah. So if they're thinking about selling their business and the spouse has been doing that kind of stuff, and you're thinking about selling in the next couple of years, they should probably be thinking about maybe spending the money to have a bookkeeper doing that kind of work, or maybe part of it, like you said.
Yeah,
So
who could come in and oversee things.
So let's go beyond the financials real quick. Oh, well, before I go on, just kind of like in a nutshell, what the financials is like: stop running personal expenses through the business, report your cash, hire a professional to do your bookkeeping to make sure that it's proper, that it's correct. Keep your financial information organized, and keep all your documents that you possibly can keep. That you can keep and make sure that they're organized. That's kind of summarizing the financial aspect. Anything I'm missing before we move on to things outside of financial?
One of the things that you may want to do is invest in the CRM as well as the IT infrastructure of the business, because keeping that it will help in keeping that financial data. You don't want to run it out of your C drive or a flash drive. It should be either outsourced IT, for companies at least 5 million and up. Even under that, if you're already a $2-3 million business, they should have a good infrastructure outsourced or in-house. In-house could be a little bit more expensive, but having that outsourced might be a good idea. Where they can keep things in the cloud, backup, do checks that are IT related, antiviruses, and everything that could not interrupt the business flow. Because if, let's say, somebody got into their computers and holding the data ransom, that could be interruption of business.
Right. Well, that's a good transition. I'm glad you said that, Diana. And that's a good transition. Is besides that, we touched on it a little bit, but I want to dig a little bit deeper. Outside of the financials, what other things are you scrutinizing from a due diligence process?
From the due diligence process, I usually look into operations. How is business operated? How many people they have? How many levels of leadership they have? Who is doing the actual work? I look at the organizational charts to map out how much is the owner involved, because if an owner is involved very heavily in the business without having somebody else back up and he wants to retire, that business might have a lower level of value at the time of the sale.
Absolutely.
You see.
Take an instance real quick. Like if the owner is doing all the diagnostics at the shop and there's no other mechanic that's really good at diagnostics, it could take a hit because, a new buyer comes in and, that buyer may not have as strong of an automotive background as the seller and may be looking at it from more of a business standpoint, but now there's nobody to do the diagnostics on the cars. So start training your staff to get better and better at diagnostics. That's just one example of what you're talking about the owner's role.
That's right. And other examples could be, having people on staff and paying them cash instead of having payroll service and putting them on books and getting a little legal deductions, through the business, because those are, those are expenses that are good for the business. So training them, providing the employees constant training, looking at the marketing, how they acquire their customers, their customer base, how they manage it, and list goes on and on for the operational things that are beyond financials.
Warranty records,
Warranty records, absolutely.
Database of going back to what you're talking about IT, having a good database of your customers, so you have something, because that's probably what's holding the most value, is not your furniture, fixtures, and equipment, your inventory, things like that. That all has a value, and that's all built into the price. But a large portion of that value that you're going to be selling is the goodwill of the business, which is the name of the business, the reputation of the business. But the customer base is the most critical, and that's one of the biggest things that a buyer is going to be asking for outside of a financial perspective is, how big is your database? How many people do you have in your database? How accurate is your database? What kind of information do you have on your customers? Do you have their phone numbers? Do you have their email addresses? Do you have their physical addresses? Because all that information the more information that you have on your customers, the better it's going to be for that new owner to take it over when it comes to marketing and advertising. They can, do emails, they can do, they can call, they can, send out mailers, whatever it is. And as well as the history of the vehicles themselves for those customers, and how often are they coming in, and how much are they spending, So that customer database is huge.
That's right. The average price per ticket and so on and so forth. Exactly.
Now I don't know if you get involved with this, but a lot of we even getting into environmental concerns. You own an automotive repair shop, and you're dealing with oil, and depending on what kind of services you offer and things like that. A lot of times most of the time, a lender is going to be asking, has there been a phase 1 or a phase 2 environmental study done on that building recently? Whether you're leasing it, but if you're buying it, but if the building's being bought, for sure that's going to be brought up. And renting, a buyer should even be looking at that type of a situation too, so that they know they're not inheriting an issue that it's already pre-existing, that they're going to get dinged down the road on, from an environmental situation.
I actually do get involved in that part of the due diligence process.
Oh, do you?
So
okay, good.
having that part of it, but asking the right questions lead to the right answers, and it's part of the interview that I have, ongoing interview that I have with the seller. So as I get my report prepared at the end, I disclose that information as well based on the answers that I receive from the seller. So yeah, the answer is yes.
And then we got furniture, fixtures, and equipment. Furniture, fixtures, and equipment.
Yes, depreciation and everything, as well as the warranties.
Yeah. Is it in good condition? When is it going to need to be replaced? How many lifts you have, obviously, but how old are those lifts? Have the motors been, replaced recently? They want to know when a buyer wants to know when they come into the business and acquire the business, what are they going to be looking at? Are they going to have to spend a lot more money upgrading the equipment over the next couple of years, or are they kind of set for a while? Where are they sitting with that? And that could play a big value on the price as well. And Diana, this is always a catch-22 because if you have all brand new equipment that you just acquired within the last year, as a seller, you're probably not going to recoup that entire investment when you go to sell your business. But if your equipment is really, really old and needs to be replaced, you're going to get dinged on the price. So it's kind of like you got all brand new equipment. Yeah, you're probably not going to see you're probably not in the sale of the business. You may not recuperate the furniture, the whole thing, but also
Unless
you
you
will get
have an
nailed if it's too bad.
appraisal. You see,
Yeah.
unless you get an appraisal on the equipment. If it could be in great condition, it could be old, but it could be in good condition because you had maintained it. And if it's not broken, you don't need to fix it, but you're maintaining it. And it's been appraised with all of the, by the right appraiser who specializes in this type of situation and can give you the right value for for that equipment.
Yep. And if your lifts are old, but you replace the motors and you replace parts and it's maintained well and it's operating great, as long as it's got a decent life cycle, is basically what you're saying.
That's right. Good life cycle. It has to have that.
Yeah. And then, inventory, if you're a tire, you sell tires, inventory will play a large part. You might have a lot of inventory in your shop. But how much is any of that inventory unsellable? You have a lot of inventory that's been sitting there and, you're not moving that inventory. That's not going to be included in the sale of the business, any inventory that is unsellable. So
it has to be salvaged or somehow has to be salvaged, removed from that. But usually if your tires are good, and they're like certain brand, or could be off-brand, but they're very good in running, and there is a big turnover of the tires, that is a good indicator that you're selling it. You have a big demand on those tires, just to give an example. But if they are already worn or out of warranty and you can't sell them and you can't do anything about it, that's a red flag for maybe business is not going so well.
Yeah. And then, how many SKUs you have, and the buyers want to know, how many SKUs you have. And, it would be nice to have a breakdown if you're able to, of, what SKUs are selling at what rate, so that they can see what your biggest sellers are and your least sellers. And it's not a bad thing or a good thing. It's just, that's what buyers want to know is, what's mainly being sold out of that tire shop. And so they get a clearer understanding of your business. And if you can't provide that information, it gives them a hard time to kind of plan things in the future as well.
That's where you do inventory audit. Doing inventory audit and reconciling books to the shelf. Now that would be doing it constant and having a inventory system in place to have the SKUs, description, the price of the tires is essential, and the date that it was purchased. So, and you could see the aging of the inventory because of that. And you can even break it down. So having good records, again, or investing in the system that would maintain good records is a good practice.
And so how from your perspective, how does profitability factor into the due diligence process, the profitability of the business?
So I look at the profitability as like revenue indicators, tracking benchmarks, gross profit margins for auto repairs are usually 50% higher service repairs. So, if you're working with an accountant, and meeting with them on monthly basis or quarterly even basis, right? Those things would usually be in the breakdown, and in the financial reports, part of the profit and loss statement. So you have your revenue, you have your gross profit, and then you receive your profit margin, and then you have your expenses, and then you have your net, revenue. And in between of your expenses, you have a breakdown of all of the things that go into the expense, hopefully business expenses, not
And
personal.
and you're benchmarking that against the sub industry, like tire shop against a tire shop, and auto repair shop
Exactly.
against an auto repair shop industry averages, and whatever it is, a collision shop. You're comparing what is this right? The cost of goods, on that tire shop, are they comparable to what it typically is in that industry? Is the profit
Yes.
margin, the rent, that type of a thing, and it says a
And
lot
the
about the business.
percentages, you get percentages for each. Are you spending too much? Are you spending too little? And how you comparing against last year of the same month, let's say to January of previous year. How did your rent go up? Or your mortgage or your insurances, and any other categories that are there.
Years ago, I saw a tire shop owner. The business was actually listed by another broker, and I was working with a buyer, and their numbers were, this is probably going back 6 or 7 years ago. The seller's profitability the year prior was, I forget what it was because it was so long ago, but it was so much higher than the year before. It was incredibly higher. And what they had done was they had so much inventory that they stopped buying inventory, almost stopped buying inventory for a year. They had a warehouse of tires, and they stopped buying inventory for the year prior to the sale. And they were trying to get away with inflating the profit of the business by not acquiring new inventory. And, that's not sustainable. And that is actually unethical. I imagine that would have been, if somebody did buy, my buyer, obviously we walked away, but if a buyer did end up buying that business through it's the legal issues that would happen post closing, because that's just wrong to do that. But that's the kind of stuff that comes out in the due diligence process anyway. Anyways, obviously
That's right.
we didn't even get to that stage. We got to the stage that we got their financials and we noticed it right off the bat and we stopped pursuing it. But you know, if somebody doesn't catch it there, it's definitely any caught in due diligence. So don't play games with that kind of stuff because it will get caught, and it's not the right thing to do. And then you're going to be looking at lawsuits, and you're always looking over your shoulders. Just do the right
Yeah,
thing,
and
I
those are
guess.
expensive. It's just not worth it.
Right, right. So what are some key KPIs, key performance indicators that buyers and forensic accountants focus on?
So the KPIs that we look at are various things, actually. Um, Profitability. We look at the benchmarks of profitability. We look at expenses that are generated by the business. Just to mention two, and efficiency, the growth, as well as
Efficiency, that can take on, just dig a little deeper, that can take on things like, how much is each tech bringing in on a monthly basis, and you're doing it as far as work on a monthly basis, how much are they, making from that, and, how many, it's digging deep into how much how
person
much each bay is
performance.
making,
Yes,
is doing on a monthly basis, how much one is making it, how much each individual employee is doing as far as work goes from a monetary standpoint. So I'm just kind of digging in deeper, but there's a lot of little things that are buried into
there
this.
are
Go
very
ahead,
little
Diana. I'm
things.
so sorry.
Yes. So for KPIs for the repair shop, KPIs are tailored for operational performance and financial metrics specific to the industry. So if it's specific to the industry, the KPIs will talk about, potential of a business growth. So how, let's, like you mentioned, the individual tax or, the salespeople, of the company, that are what is their performance and what are their sales goals, and what do they bring into the business? Are they a liability or they're an asset? Basically, that's what KPIs are measuring.
Great. Great. All right. So what are some suggestions you can give a business owner to improve their financials and operations to maximize their sales price before going to the
I would
market?
say one of the things that I would give away is to work with a professional. Never recognize that there is a need, and that need needs to be fulfilled, and bring in a quality professional into the business who would help the business to be organized on all aspects of the business: financial, operational, compliance, HR, taxation, um, uh, uh, what is it? All these aspects and more, so that you are able to get the maximum value for your business. It may seem like it's a huge undertaking, but the sale price at the end, you will recoup it. They
And
will
you'll
recoup
be
it.
very happy that you did. And I'm going to go one step further, and I'm not just saying that because saying this because I'm a broker and I'm not. But I really think that if you're looking to sell in a couple years, that you should reach out to whether it's me or to another broker that's very, very experienced, that specializes in selling auto repair related businesses, so that they can they can look at your financials, they can ask you a bunch of questions. I talk to a seller, I call it a seller assessment call. And I talked to the seller for about an hour, asked them a bunch of questions. And what I'm trying to do is I'm trying to put on that buyer's hat. I'm not doing due diligence, but I'm putting on the buyer's hat. And I've talked to buyers all the time that are looking to buy auto repair related businesses. I know what things they're looking for. I know what things that turn them off from those type of businesses. And that gives them an opportunity to be like, okay, hey, love that you're doing this, 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 and that. These are the areas that you need to stop doing immediately, is this, this, and that. And if you can work on this and that over the next couple of years. And that's why I think a seller should talk to, whether it's me or somebody else, again, that's experienced in selling auto repair businesses, that specializes in it. That plays a big part. And like, I don't charge anything for that. That's, to me, it's like I have an hour conversation with that individual every year until they're ready to sell. It's just providing good service. They're not obligated to use my service. It's not, it doesn't cost them anything. And again, I'm not trying to sell myself. Whether you use somebody like me, whether you use me or somebody like me, just make sure you talk to a business broker that specializes in selling auto repair businesses, that's very knowledgeable, because that'll pay off pay off big time as well.
Exactly.
So any final advice that you can give somebody looking to sell a business, or let's flip this the other way, any advice you give a buyer
And
that might
an
be looking to
advice that I
acquire
could
business?
give is to work with, again, with a professional, to have their ducks in a row, dot the T's, and get all the paperwork correctly the first time around. And if they don't, they need to hurry up and get that done and start preparing for the sale. Going back and reviewing things that happened before, because don't forget, there is 3 to 5 years, unless the business just been opened and they're trying to sell it. The cycle is 3 to 5 years. 5 is the best number of records that they can prepare and give.
Excellent.
So, get ready for that. Hire the right professionals, talk to people. Some even offer free consultations, professionals in these fields. So I would definitely encourage them to get it right the first time around.
That's excellent advice, Diana. And I got to say, Diana, that it's I know somebody listening to this might be like, oh my gosh, this is so much. They covered everything. Like, this is going to be a major undertaking. It's really not. It's basically just, keeping your information, keeping it organized, not writing personal expenses through the business, having all your backup information, hiring a bookkeeper to come in on a monthly basis, maybe hire a consultant that consults with auto repair business owners and come in and guide you and give you some advice. Talk to a broker like myself, and just kind of run your business the way you should probably be running it anyways. It's not a lot of work. If you really break it down, it's stuff that you should probably be doing anyways. It'll make your business better. And that's probably the biggest thing I want to leave with the viewer is that, if you do the stuff that Diana and I are talking about, even if you're not selling your business, I guarantee you that you're probably going to be more profitable, and you're going to be a lot less stressed as a business owner because your business is operating the way it should be operating anyways. Just you're focusing on it now instead of working
And
in
it'll
the
be
business.
successful
You're starting to
too.
work on it and be successful.
That's
Diana, I
right.
really appreciate you joining us today. Thank you so much for your insight.
Thank you for having me today.
Hey, and please, if you're looking to buy a business, or if you're a seller and you want to pick Diana's brain and talk to her, please reach out to her. You'll see her website address down below her, and please reach out to her. She's a wonderful person. She can direct you. And if you're thinking about selling your auto repair business, please reach out to me. I'd love to talk to you. And I appreciate you joining us today on Let's Chat. And until next time, have a fantastic day.
Sounds good. Thank you. Until next time. Thank you, Jim.